That's where we're seeing companies win. Engaged leadership teams, engaged employees that understand that healthcare is impacting not only them as individuals, but it's also impacting the person sitting beside them. Thanks, everybody, for joining us today. And today will be a fun episode and one that we think is vitally important right now, not just for self-funded employers, but also for fully insured employers. It's really important to know what's happening right now in the stop-loss market. And the most recent reports are telling us claims are getting larger. And those large claims are happening more often. And if you haven't seen it, Tokyo Marine, they put out their 2026 stop-loss report. And two key things that stood out there. One, much claims have started rising. So the key stat there, claims over $2 million have risen 213% since 2020. Claims over 500,000, they've risen as well, but not to that degree. So again, what does this tell us is that large claims are happening. They're happening more often. And whether you're fully insured or self-funded, they're going to be happening in your plan. What we're going to talk about today is really what we're seeing with high-performing groups that own their benefits and how they're impacting those claims. We're going to talk about some success stories of those that have been able to mitigate those or reduce the cost and help their employees. And then today, what you as an employer can start doing to have an impact on these high-cost claims. Last thing I'm sure we'll touch on a little bit is what is the long-term strategy for stop loss? How do you look at that? How do you manage it? It's such a significant portion of a self-funded plan sponsor spend that you have to have a strategy around. So Steve, why don't you kick us off there with stop loss and strategies? What are you seeing in the marketplace today? What are employers seeing? And then really, what are the first couple questions you need to ask?
Yeah, and let's take a step back and even just talk about what stop loss is. And there's two forms of stop loss. And, there's actually a couple, but two forms of very common stop loss. You have your specific deductible and you have your aggregate deductible. Your specific deductible, that's where you're going to have more frequency in claims. And so it costs usually 10 times as much as your aggregate deductible. Your aggregate deductible, think about it as an umbrella over your entire stop loss policy, ensuring that your plan doesn't exceed a max claim. And if it does, you will be reimbursed at the end of the year for that amount after rebates are calculated in and the TPA reconciles. Specific deductible, think about this as per belly button on your plan, a max risk per individual from the employer standpoint. So let's just use $100,000 here as an example. So of course, the employee, they still have their deductible, their out-of-pocket max, their copays, whatever your plan design is. And then the employer is liable for all claims up until $100,000. Once it hits $100,000, everything after that is paid for by stop loss. So you just mentioned claims frequency of $2 million claims and more is up 213% since 2020, right?
Mm-hmm.
So think about a $2 million claim. The employer would pay the first $100,000 and then stop loss would pay the last $1.9 million. Those have risen 213% since 2020. And so an employer, if you're thinking right now, okay, I have a $2 million claim, got it. My risk is capped at $100,000. I have my specific deductible. I'm good. Well, if that claim is ongoing, what do you think is going to happen with your renewal? Stop loss just spent $1.9 million on one individual. You're likely going to get a significant cost increase at renewal. So how do you have an impact on that claim, right? That's step one. How do you impact that cost and help that individual that's likely going through one of the, as you know, the toughest healthcare situations or toughest situations of their entire life? And then that aggregate deductible, to be clearer there, that is claims under your specific deductible. So if you have a lot of claims, 20, 30, 40,000, a lot of $10,000 claims that add up to a certain point, that's what you're liable for. So you want to make sure if your entire population has a lot of claims under specific, you still have a cap there. Majority of our employers, they have an aggregate deductible. We would recommend that in the first year, at least the first few years, until you get an idea of how your stop or your self-funded plan is performing. And so that is usually much less because an aggregate hit doesn't typically happen. You're not having that many claims under your specific to hit that max liability. You're typically having those 2 or 3 really high cost claims that stop loss is paying a significant amount for. So when you do have that high cost claim above your specific deductible, I think the question employers should be asking is, what can I do about it? And like, it's there, it's happening. We have a $1 million, like, what can I do to impact this cost now that it's already ongoing?
And what we've seen is that the traditional model, most employers just say, hey, we have a $100,000 deductible, insurance pays the rest. And not necessarily a bad strategy. And it is why you buy insurance. It's that risk transfer, which again is a very traditional way to look at it. But what we're seeing employers do is start to look at that relationship of stop loss costs to their entire plan. And they're thinking, hey, yes, we still want to transfer risk, but we also want to look at impacting those dollars.
Mm-hmm.
And what we've seen be possible is this is where paying less for claims comes in. And you'll hear us talk, and often is there's 2 ways to pay less for claims. One way is to prevent claims. The other way is to pay less for claims. And some of the strategies we've seen be effective when paying less for claims are things like your PBM strategy, your infusion strategy, your large claim strategy. How are you helping employees get access to programs out there that can help them find coverage or potentially transition coverage to a different point when they qualify? We all in the US, as taxpayers, pay into programs that are designed to help people going through tough situations. Again, going back to engagement. The engagement here is key, and there's a couple different ways to have engagement. One, an aligned leadership team that engages their employees and communicates why healthcare matters. If you're an employee-owned company, it's a little bit different than you're a publicly traded or a private equity-backed company. But everybody needs to understand why they have an individual stake in healthcare. We've seen companies communicate that on an individual basis and on a group basis. Depending on how you run your company, potentially like an Evergreen or an EOS, or you run an open book style company, healthcare costs on the P&L and showing your team where that stands is a really easy way to do that. So that's an engagement piece to get people, I would say, optionally or voluntarily engaged. The other way we often refer to it would be required engagement. And this is where plan partners play such a pivotal role, and really the role of the TPA or a care coordinator. That's really where you're able to require that engagement with tools that you put in the plan to execute. So what does this look like? It could be you have specialty drugs that we have some employers that say, hey, we want to offer a way to save on those. We want to offer a solution for our specialty pharmacy. And employees can choose to opt in and pay $0 for those drugs and get them on a much cheaper basis for the plan. Other employers we've seen, they completely exclude those specialty drugs, and employees can fill those still for free, but they have to use that specialty pharmacy option. So that's one that most people are familiar with. Take this a step farther into infusions in a plan. So when you have a really strong TPA that's able to assist with care coordination and help with some of the pre-cert, they can catch that pre-cert and actually drive that employee towards an alternative infusion pathway. This is where we're seeing the highest performing employer healthcare plans really have an impact. So again, the combination of voluntary engagement plus required engagement, it is all dependent on what an employer is comfortable with and what a leadership team's comfortable with. In our opinion, you can't really have one without the other, or you create a lot of frustration within a plan.
Definitely. And yeah, the employer is going to save money on these claims with what they're liable for under their specific deductible. If they can help these employees with the strategies you just recommended, they're going to pay less. But then, of course, stop loss they probably won't pay anything or much less. May not pay anything at all, or they're going to be paying significantly less for these claims. And your stop loss spend, if you look at your overall, you have your claims and you have your fixed costs. typically stop loss costs are about 25 to 40% of overall spend. And when those costs are increasing at 10 to 15% every single year, that becomes an issue, just like the whole program getting a significant increase. So these strategies, yes, they protect what comes out of your bank account every single time you pay a claim, but it's also protecting the renewal that stop loss is giving you and in giving employers, right? Because the stop loss carrier is going to be paying less for these claims as well.
Yeah. Let's talk a little bit about the stop loss, I would say, ecosystem today, specifically captives, consortiums, standalone stop loss. Let's talk through really kind of just high level, the basic options there. And we could have a entire series on each of these.
Mhm.
And there's going to be someone out there that's going to say, hey, you guys didn't talk about this, this, and this. And that's completely fine. This is a high level overview. But let's start with the captive space. And this is something everybody has heard. It has really become, I would say, almost a marketing term in our business today. And for good reason. Captives can be such a great tool for a self-funded mid-size employer, especially transitioning from fully insured to self-funded. And if you think about this idea or the concept of a captive, essentially pooling risk with employers to reduce your liability when you have those large claims that hit stop loss. And in the simplest thought, think about if you have that $100,000 specific deductible, and then you have a captive layer on top of that. And depending on what captive you're in, that can be a floating or a fixed layer. It's really important to understand that if you're joining a captive. And then there's reinsurance that sits on top of that. What we have seen is the significant growth of captives over the last 10 years in the business has created a lot of, I would say, confusion. And this bright and shiny word of captive where people, hey, it can save money. It's just not true. And what we've seen is how employers are choosing to join which captive and choosing to pool their risk with whom is driving significant results. So if you could talk a little about why that matters and, why pooling your risk with like-minded or similar employers, why it makes a difference and how that's probably changed and evolved in healthcare differently than it has in the property and casualty world where homogeneous captives have been a thing for a long time, for years and years and years, and why now in the healthcare space, that mindset is starting to be embraced as well.
And so I think it goes back to who your captive manager is and how they're compensated. So get that right first. Of whoever you're talking to, ask how your captive manager is compensated, and if they get paid a percent of your stop loss premium. Just think, if your stop loss premium goes up, they get paid more. Conflict of interest. So number one, ensure that your captive manager is being paid a flat fee.
Same thing if you have a self-funded plan today and you're standalone and your advisor is getting paid a percent of stop loss, that was a industry norm 10 years ago. I saw a report only 10% of plans today are paying an advisor through a percent of stop loss.
Love that. And I mean, it's a complete breach of a employer's fiduciary responsibility when they're self-funding the plan sponsor, if their partners under the plan are getting paid a percent of premium. So with a captive, as Brandon mentioned, it's all about who you're sharing your risk with. And joining a captive doesn't mean you're going to save all this money. The idea is it stabilizes your renewals. The only way you're going to save money on healthcare is to pay less for claims or prevent those high cost claims from happening. That's how you do that. But if you can create a pool of employers who are doing those two things and have a focus on managing a healthcare program versus just buying health insurance and thinking about it every 12 months, that captive and those renewals are going to perform much better than the captive who just lets whoever in and there's no active management. So ensure you're joining a captive where there's no conflicts of interest and the groups you're pooling your risk with. And I would even recommend interviewing or talking to the other employers in the captive that you're joining and asking what they're doing to pay less for claims and prevent them from happening. And if they don't have an idea, or they look at you like you have a third eye, I would not join that captive. And so again, like Brandon, you're not going to save money just by joining a captive. It's going to help stabilize the renewal that you get on your stop loss, which is about 25 to 40% of your overall spend, and left unchecked can become an issue. We're seeing the highest performing captives across the country, and we started one of our own. They're running at pretty much flat on a stop loss renewal after distributions happen at the end of the year. And that's where you really want to be. You want to keep your fixed costs stable and flat, and you want the majority of your dollars when used to go pay for claims. Those are the dollars that are actually being paid for healthcare instead of health insurance, and to pay different vendors. So your fixed costs, the goal is to keep them flat. Your claims, you want to pay less for claims and prevent them from happening. But that's what you want the majority of your allocated dollars to go towards.
And just in the simplest term, think about two pools.
Mm-hmm.
This is the analogy we always use. Think about two pools. One over here, crystal clear, pristine. You can see 10 foot down. It's like the water in Lake Michigan.
Mm-hmm.
Over here, you've got a pool that's murky, green, swampy. You can't see 6 inches below the surface. Which one do you want to jump into? You want to jump into this clean pool and you want to hang out. What's happening today is there's very large captives that have grown in the marketplace, and kudos to them. They have done a mastermind and really a masterful approach to growth and sales. And that is the right place for some people. But what we know is that strategies around cost containment and cost management aren't happening at every or all employers in some of these. And that really brings to the question, is bigger always better? And our response there would be no. And I think the second follow-up to that, a lot of times people go, well, hey, how can this captive over here with 25 or 30 employers, whatever the case may be, perform like this huge one with thousands of groups? And, I typically come back with the question of, there's companies out there that are 200 employees and they're standalone, self-funded. If you believe in the captive model, which it's still growing today, even if you built a 2-person captive, 200-person companies, and they were both doing the right thing, I would argue their risk would be lower together than on their own. So if you believe in that, and yes, if you can scale that, and that's where it becomes difficult, right? Is as you start scaling with these strategies with aligned leadership teams, paying less for claims, private TPAs, doing the right kinds of claims management and program management, it's hard to continue to find groups that want to do those things and bring them all together, but it's happening. And I think that's what makes me excited today, and it makes me excited about what is happening in the industry. Is there's more focus on claims management. There's more focus on finding the hidden fees and costs within healthcare plans. And you're having big voices in this industry start to play a part. And they're being upfront about it, and they're talking about it. And you're having people like Mark Cuban, and you're having different physicians, and you're having different provider leaders step up and say, hey, there's a better way to do this for employers. We can keep healthcare local. We can look at partnering employers with providers. We can pay less for prescription drugs. We can pay less for infusions. We can help large claimants get to lower cost care. Seeing groups that are doing all that and want to win together, I think really is maybe the future of the captive model. But today, there's a lot of different options out there. You got to do what's right for you as an employer. It's just we would recommend asking those questions of, who are you sharing your risk with? How's your captive manager paid? And understanding, what does a historical renewal look like? And how's the captive performing today?
Yep. Think about also bonuses, kickbacks, contingencies. Pretty much every other industry has removed them. And when you're joining a captive and you're looking at your stop loss carrier and the captive manager, so, okay, cool, they're paid a flat per employee per month. But is that captive manager receiving a bonus or a kickback from the stop loss carrier for placing business with them annually. That, in our mind, could also be a conflict of interest because that captive manager may not be incentivized to pick the best stop loss carrier for that sell because they may not be getting those kickbacks from that stop loss carrier. So that's something to keep top of mind as well. A consortium or consortium, think about that very similar to a captive. You're pooling your risk with a group of other employers, but there's no captive collateral and you're not really taking ownership of it. And so two different things, very similar. And then of course you have standalone self-funded, which you're not pulling your risk with everyone, but you are buying a stop loss policy that others do have an impact on that renewal, believe it or not, even though if you're standalone. So that stop loss carrier, they're seeing their block of business and how everything ran, and then they're still dispersing a renewal based off that block of business. So a lot of different options, and it's just important, we believe, to be educated on what the options are, what they mean, so you don't end up in a bad position. Whenever a company makes a change to one of these programs, it takes time. It's different work. I don't think it's more work, but it's definitely different work. So you typically want to make sure when you're spending the time on this, you're picking the right program for your company and your employees, or you could end up in a tougher spot than you were fully insured.
Yeah. And it goes back to when we always say this, and we'll continue to say this, is nothing in healthcare is a one size fits all, even with stop loss. And a lot of people just say, hey, you're buying insurance, and it's not the case. There's nothing that's a one size fits all when it comes to the stop loss space as well. And it's changed a lot. And, I think the reason we're talking about it today is because what we're hearing from the large stop loss carriers in their annual reports is that the stop loss market is hardening. And what we're seeing, groups that pool together, have that like-minded, or they have a really strong captive manager that's focused on the risk they bring into the pool, is we're seeing them be really successful. I'm working on a renewal right now. It's a 10-1 renewal. They've been with this captive manager for years. It's one that's well known, that everyone's familiar with in the space. And they've performed really well. Single digit stop loss renewal, kind of first pass. They've got a $75K spec. They have an aggregating specific deductible that sits on top of that. If you don't know what that is, there's a Self-Funded with Spencer episode. I'd highly recommend going and watching that to get a little bit educated on some visuals with stop loss. But
when I said there's multiple, that's the other form of stop loss I was referring to.
But they've continued to run well from a stop loss standpoint. And not only, I would say they ran less than an inflationary trend in the stop loss space. And, just like everything in the world today, there's an inflationary component. But keeping an eye on that stop loss spend is something we see a lot of employers may not be giving enough attention to. Let's talk specifically a little bit about grouping like-minded employers together, and what we've seen change there. So if the P&C and the property and casualty marketplace, and I'm not an expert there, but captives have been in effect much longer than the healthcare side. And it was very common to say, hey, we're going to build this homogeneous captive. We're going to put 100 trucking companies together. We're going to put 100 manufacturing companies together, and we're going to build captives that way. Whereas healthcare, everyone kind of said, hey, everyone's got healthcare claims. It doesn't matter. It doesn't matter what kind of company you are. Everything can be heterogeneous. But we're seeing this wave of putting like-minded employers together. Why are people doing that?
Well, I think it goes back to the property and casualty, like you mentioned. It's the industry. In healthcare, we would argue it doesn't really matter what industry you're in. Two trucking companies can have absolutely different claims and different risks based off their employees. So it goes back to the ownership mindset of the company. And does a leadership team, one, want to make healthcare and benefits a priority? Two, do they want to spend time on it? And three, do they want to spend enough time on it where they create a strategy to have long-term success, and it's an annual program rather than an annual renewal? And so when you get a group of employers who are bought in on that, and typically we're spending about 6 months to a year with a company, learning about their leadership team, learning what they want to accomplish, what's happening today, what they like about their program, what they're unsure or frustrated with, what they want it to look like 2 years from now, what they're doing to manage claims, what they're doing to look as attractive as possible to the carrier they're with today. And then we recommend a strategy for them. And then they have to be bought in on that strategy to obviously want to implement it. And that process takes 6 months to a year. So we're getting a pretty good idea of the mindset and where a leadership team is today and how aligned they are, and if they want to take ownership of their benefits or not before we even recommend any type of product or program to them. So in our mind and our philosophy, it doesn't really go back to industry of company. It goes back to ownership mindset and how they think about healthcare, if they want to engage their employees, and if they want to manage claims long term. Again, different work, not more work than most programs across the country. And when you group, and I want to hear your thoughts on this, when you group companies together with that ownership mindset, and I mean, you get them all in a room together. Once a year, you're going to likely travel and have some type of conference or meeting with these groups who are all pulling their risks together, sharing ideas, best practices, and talking through how they're managing claims or paying less for them. It's really fun. And that's how you're going to create, and it's how we've created the highest performing captive in the country, because we picked ownership-minded employers rather than an industry of employers that we think could group well together.
Yeah. And that's been one of the really fun things, I think, working with our partners today, is seeing them interact with one another and learn from one another, and being able to do like group education.
Mm-hmm.
We just had a call this week. We had on a reference-based pricing vendor to just do some education.
Who will likely have on Own Your Benefits at some point.
Yeah, we wanted them to do education for all of our clients in a group setting. So it's just not often you can get 10 to 12 of your clients, 10 to 15 of your clients on one call together to hear something. So that's been one thing that's really fun, and I've absolutely enjoyed that process and building that, and looking forward to seeing it grow with the right people.
I mean, think about that for a second. Getting 15 of your clients on one call together where anyone is allowed to unmute themselves or comment. I mean, that would be some advisor's worst nightmare. And we're doing it every other week.
Yeah.
I mean, that's
fun.
Just thinking about that, that's crazy. Yeah. And that's been, I agree. That's been one of the more fun parts of it. Okay. Let's talk about maybe 3 success stories today that, we talk a lot about: managing claims, paying less for them, preventing them from happening, and how it impacts your stop loss spend. Remember, 25 to 40% of overall spend. How do we protect those fixed costs so they don't continue to rise? 3 examples that are on my mind right now: a premature birth, $1 million plus claim; a childhood cancer, which is one of those $2 million claims; and then an end stage renal, which is over a $600,000 claim to date this year. So I'd love if maybe you talk about the childhood cancer. And I mean, it's such a sad story, but we've been able to impact their family significantly. So maybe talk through that a little bit.
Yeah, I'll talk through that, and then actually one more as well on the infusion side.
Great.
That came to my mind as you were talking through those. So this group, they've got about a $4 million planned spend. And when we were last year's renewal, we were looking at the strategy for this year. And we the data told us that there was an ongoing cancer claim, and it was a dependent of an employee that was going through a really hard time. They had been for years. And for them going into 2026, they had put a laser, so a larger specific deductible. And if you don't know what a laser is, that's where they raise the specific deductible, because the stop loss company would essentially, they would apply more premium if they didn't put that laser on there.
And think higher specific deductible, more employer liability. You're paying up into that deductible.
So if this group has a $100,000 specific, they wanted to put, I believe off the top of my head, I believe it was somewhere in the range of $700,000 laser on this individual.
No, I can picture the spreadsheet in my head, and it was an $850,000 laser.
Yeah.
I can picture it.
And what this group had done, they have a very aligned leadership team. They knew they wanted to have an impact on healthcare. They had calls with their key level leaders. They had educated them on why they're doing the things they're doing, why they're rolling out these programs. And they ultimately decided that they did want to roll out a program to help, hopefully, this individual. And these programs, again, goes back to the engagement. Engagement's typically the hurdle here. You can't obviously go directly to an employee. This is all HIPAA protected PHI. So we can't discriminate in any way. We have to offer this broadly to a group. And that's what this group decided to do to try to help this individual. And the employee actually ended up engaging. And what we knew was likely is that this dependent, since it was a childhood dependent, what we also knew is based on where they were receiving care, it was outside of their footprint as a company. So someone was traveling a significant distance. But this employee did engage with the program and they actually were accepted. And this individual, they qualified for assistance to be part of a program that was going to take their costs to zero as an employee.
Yep.
So they were driving not only their healthcare costs, but also their lodging. They were driving back and forth. I think it was over an hour, at least once a week.
The stress
sometimes twice.
That puts on a family.
Sometimes twice. They're driving to receive care. There are multiple inpatient stays. Claims received of that plan and that 2025 are well over $1 million. But the individual, they were able to take their cost to zero and receive additional assistance. So they were able to qualify essentially for funding to help their family going through probably the hardest scenario you can go through as a family. And the feedback we got from that individual is how thankful they were that this group decided to deploy a program to every employee that they had access to. And ultimately, I would say, and there's no way to measure that, but it's going to take their stress of their family significantly down. Obviously, they still are dealing with a very hard situation, but they don't have to worry about the financial stress, and they're also getting assistance to help them. So it was a huge win for them, but then also for the plan. It all, for all intents and purposes, it helped remove that risk from the plan. They kept the laser in 2026, which is why sometimes lasers can be very good if you're a self-funded program. If we had to remove that laser, that would potentially have been dollar for dollar risk transfer back to the group in premium.
Yep.
So for them to keep that laser on that individual, it kept the premium lower for the rest of the group. This employee was able to win. The group was able to win.
Yep.
So that's an example. Paying less for claims, that impacts the stop loss ratio in 2026, sets them up to have a better renewal in 2027.
Love that. And I want to share one before you talk about your infusion story. Similar situation, but it was a premature birth and mother had the baby very early and 2 life flights. Mother is okay and now baby is okay, thankfully, but it is a significant size claim and the dollars are still coming in. Well, we were able to help that mother find government funded programming because of how early she had the baby, and the baby actually had a little bit of a disability. And I believe it's Turner syndrome. And typically when you have a premature baby, they're born with a little bit of a disability or something that's going on. And that qualified them for a federal grant and a disability benefit that, again, same scenario. It took the cost of healthcare for that mother and that family who would have a deductible and an out-of-pocket max pay, took it to zero, and it also paid 100% of those claims, so the plan didn't incur any of those expenses as well. It wouldn't have been ongoing, but it would have impacted the captive in the pool because it would have hit the captive layer and taken dollars out that could have been returned to employers at the end of the year. So that's an example of a company that's, yes, it wouldn't have been ongoing and it likely wouldn't have impacted their stop loss renewal too much, but they knew that it was going to impact every other group in the captive. This employee understood the why, what it meant for them, and so they decided to engage, and now that's helping that individual, their family, the company, and the captive as a whole.
Yeah. And then the other one that I mentioned, the infusion. So an individual, they were driving, I want to say it was 45 minutes to an hour. I can't remember if it was once a week or once every other week. But they were driving to a facility to receive care, and this was a J code. So this was a cancer infusion being received through the medical plan that was significant cost to the plan. And then this individual, between executing this once or twice, was going to be hitting their deductible and out of pocket.
Yep.
We worked with this individual very early on in the plan year in 2026. And the reason we were able to is because when the TPA received the pre-cert, we had this program in place because we knew it was on the claims previously. But when they received the pre-cert, the care coordination team engaged with that individual. They said, hey, Mr. and Mrs. Smith, we have a program that you can get your exact same infusion for free. You can also get it 20 minutes from your house instead of driving the 45 minutes or the hour that you are today. And this is where, things can get tough. He or she, I can't remember, kind of went back and forth and was like, hey, I don't know about transitioning care, doctor, like a normal person would. It just so happened to, there was a change with the facility that she was going to. And ultimately what that individual decided to do was to re-engage with the clinical team. So when they re-engaged with the clinical team, they went through the process again, and they chose to opt in to this program. And they actually chose to change providers through the process too, to someone that had higher quality ratings, was at a more, I would say, notable facility near them, and was someone that they became more comfortable with after going and visiting with them and talking about their care path forward. So it was really neat to see that. And again, nothing is perfect, and none of this is 100% effective. That's just not ever going to happen unless it's 100% required. But this individual, they chose to engage, they tried it out, and ultimately they chose. And I think that infusion probably is going to be somewhere 30 to 40% less to the plan. And that's going to be ongoing. I don't know how long or what the notes say, but I do know it's 30 to 40% less for now.
Yep. Impactful.
Yep.
Great example. And I mean, there's just a lot of breadth of examples that things like this can have an impact on. And we're talking a lot about paying less for claims because, of course, large claims are going to happen. Obviously, as you mentioned, $2 million plus claims are up 213%, and $500,000 claims are up over 100% since 2020. They're going to happen. You can't prevent all of them. You can have an incredible prevention strategy. They're still going to happen. Last example, end-stage renal, dialysis, individual, again, sad. I mean, all these stories are sad, but the way that we're able to impact, and really the employer is the one executing on it at the end of the day. We're giving the advice, we're telling them how to do it, and that's where it takes that ownership-minded employer that wants to have an impact on healthcare to do it. But they were able to help transition this employee to Medicare. Medicare is now paying for all this employee's costs. The employee is no longer impacting the plan for that certain type of care. So for anything that's related to his renal failure, nothing is paid under the plan. It's all paid for by Medicare. If the employee wants to get an antibiotic under the plan still pays that.
Yeah.
But to date, that employee has had $600,000 of claims for that renal failure this year. And so that's, of course, being paid by Medicare. The employer is not paying for it. Stop loss isn't paying for it, and it's not impacting the captive.
What's that group spec?
$40,000.
Yeah. So significant. And that's why we're sharing these examples, because these examples are all ones that would have hit these groups specific deductible and gone towards stop loss.
Yeah.
And again, the traditional strategy here would have been, hey, you'll pay up to the specific deductible, stop loss will pay the rest.
Yeah, it's only $40,000. Like don't worry about it. That's traditional.
Yeah, that's the traditional. Whereas the progressive strategy is, hey, how can we impact these employees? How can we help them? How can we manage these claims? How can we have an impact mid-year with something? We don't have to wait till renewal to do a lot of these things. We can implement something mid-year, but it's only effective when you have an engaged leadership team, an engaged employee population with the healthcare program. And that's where we're seeing companies win. Engaged leadership teams, engaged employees that understand that healthcare is impacting not only them as individuals, but it's also impacting the person sitting beside them. It's impacting the organization. And it's just human nature to want to help out. With everything going on in the world today, and there's good, bad, and different, it's human nature to want to help people out. And if you can help educate employees and let them know that, hey, there's a couple things that you can do to help us out as an organization, they're typically going to want to do that. And it's easier said than done. And at the end of the day there's going to be times when some employees just say, hey, no thanks, that's not for me. I want to do what I want to do. And that's okay. Our argument there would be create a program that incentivizes them to engage them, helps them get healthier, but also removes the barrier of entry to getting higher quality care at a lower cost. And again, that's all going to impact stop loss long term, is what you're doing today in advance of your renewal and during the year. Again, this is a program, not a renewal strategy. Thinking to your stop loss renewal strategy and thinking to your stop loss program, what are you going to do to manage those large claims? You have a lot more impact than you think.
Agreed. Good episode. Great talking about it. Enjoyed it.
Take care. We'll talk to y'all next time.